Hi everyone and welcome to this YouTube channel. Today I would like to show you how to value Nvidia, a company like Nvidia, using a market method, in particular the comparable um, multiple method. So this is what the we're going to build this model from scratch on YouTube, on Excel, and this is what the final model looks like. I have decided to use two different panel of comparable. The first one is made of the other six companies which are part of the renowned Magnificent Seven stock, which are Apple, Microsoft, Alphabet, Amazon, Tesla, and Meta, which together to Nvidia constitute the Magnificent Seven tech stock. Not tech, but Magnificent Seven stock in terms of the capitalization on the market. And the second panel is made of business-related comparables to Nvidia, like Intel, AMD, Broadcom. So here we have the multiples of the comparable companies. Here we have all the database and financial information about the comparable companies that I'm going to use to build up multiples. And here we have some adjustment that I've made. This is a basic multiple comparable companies and comparable multiple model. So I won't make big adjustment to the denominator or numerator of the multiples. So I'm just adding a concept premium to the market cap as an adjustment to the model. And the reason why I'm adding a control premium to the market cap of the comparable is because the share price of the company, that you can find on the market reflects a minority perspective. So in this case, we are valuing the 100% of Nvidia. So in this case, it is necessary to add a premium over the comparable share of the Nvidia comparable share price. And then here we have our summary. Here I have calculated the implied share price of Nvidia, coming out from this methodology, and I have decided to compare it to the current stock price of Nvidia at the valuation date, and with the average of um, last year stock price of Nvidia, in order to, uh, I mean, understanding if the company is according to this valuation, is the company is overvalued or undervalued compared to the market. This is obviously not a financial advice or recommendation, so make this model just for fun. So this is the final model. We're going to build it from scratch, but before building this model, I would like to give you a couple of information. It will be really a quick um, explanation about the theory behind this method. If you don't like this part, obviously you can skip it if you already know the method. Otherwise, the comparable multiple approach, it is a technique using to value a company by comparing it to similar companies. And this method obviously relies on valuation multiples that you can build up from the financial metrics of the comparable companies. The main steps are identify a panel of comparable companies. As I told you, I have decided to select two panels. Then you have to select appropriate multiples. In our case, I've decided to use the most used which are enterprise value on revenue, on EBITDA, on EBIT, and the price to earnings. Then you calculate the multiples of each comparable company. You decide then what metric you want to use as the average, the minimum percentile, and then you apply the multiple you have obtained to the target company. Here you can use the suggestion is to use the average of the median. There are obviously some pros and cons about the perks. It is an easy methodology, require few assumption, and use real-time data. About the consequences, obviously sometimes to find perfectly matching comparables is not always that easy, especially for private company that operate in niches. The method obviously is influenced by the market condition, and obviously it basically fully relies on the comparables that you're going to pick. Now this is the model empty. The first step is obviously to decide what comparable companies you want to include into your panel. These are my two panel. Then you have to collect all of the financial informations from of the comparable companies. So I have collected the revenue, EBITDA, EBIT, net income of the comparable companies, taking them, taking, I mean, the information of each one of them in terms of the last 12 months, last fiscal year, which is the 2023, the fiscal year previous to the last one, which is the 2022, and this is a forecast, and TM stands for next 12 months. So it basically, this should be the revenues expected for the 2024. And I did this not just for the revenue, but also for the EBITDA, the EBIT, net income. You can collect all of this information. Obviously, if you have access, like I have on my professional computer, on the computer I use at work, you can easily download all of these informations from S&P 500, Bloomberg, Refinitiv, FactStat. You can easily download them in just a moment from these data providers. Otherwise, I recommend you to use, this is not an ad, so I'm not paid by this terminal, but here you can find all the information I've collected and you have seen on the Excel for free. So if you go, for instance, on financials, here you can find all the information I've put into the Excel. So here you have the last 12 months, the last fiscal year, and this is the fiscal year previous to the last one, which should be the 2022, if I'm not mistaken. And you should also have, oops, you should also have the forecast. Where did I get the forecast? Balance sheet, maybe on valuation. Yes, here, next 12 months revenue. Perfect. Okay. Okay, so this is the data for the next 12 months revenue. Okay, so then you have to collect similar informations in terms of the market cap, the enterprise value. Obviously, in this case, you want a forecast of the next 12 months, but you just can get informations for the last 12 months, the last fiscal year, and the fiscal year previous to the last one, which is the 2022, 2023, the last 12 months. Okay. Mm, so first of all, I'd say let's make the adjustment to our market cap, and then let's calculate our enterprise value with premium in order to then build these multiples. Okay, so first of all, let's define our control premium. In this case, generally, the theory suggests that control premium should range from the 20% to 40, right? So something like that would be okay. You should see. Okay, so let's now add the validation. Alt a vv list, now date list. In terms of the source, let's select this premium range. Okay, let's now use 30% as a control premium. Oops, let me zoom out a little bit. Okay, 85. Let's now increase the market cap with our premium. I think that I'm going to make a detailed video about how to define in a professional way the control premium. SF of ESF. Okay, okay, let's use 40%. Oh, okay, so in terms of the debt, minorities and non-controlling interest and preferred stock, let's just make it easy. Okay, has a difference between these two. Okay, because obviously, as you know, the enterprise value is equal to the market cap plus the debt plus minorities and plus the preferred stock. This is the formula. Okay. Okay, so we have calculated our enterprise value with premium. As you can see, is higher than the enterprise value without premium. Let's now calculate the comparable multiple of the comparables of Nvidia. In this case, I want to make the Excel dynamic. So here you have sort of some selector if you want to include or exclude a transaction from the panel. So in this case, we're going to say that if this is equal to 0, give me nothing. Otherwise, I want this enterprise value of Apple, which means that the enterprise value divided by the last 12 months of Apple. Okay. I think that I collected exactly. I need to collect this one. Let's now copy this formula. In terms of the next 12 months, obviously we don't have the next 12 months Ebitda enterprise value. In this case, I think that we're going to use the last 12 months for more recent one. ESF. Okay, perfect. We can do the same also for, okay, so we have, I made a mistake, I need to block this, the column, okay, it's now set, perfect, and need to do the same here, okay, perfect. So in this case, if I want to exclude, for instance, Apple from the panel, I just have to press 0, and we don't have Apple anymore. If you want, obviously you can do this approach for each one of these. It will be a bit longer. I think that is useful as well. Okay, let's now do the same for this other multiple, which means that, well, in this case it will be our Ebitda. We link enterprise value with last 12 months Ebitda, which return us 31.02. Okay. In this case, the next 12 months Ebitda, last 12 months perfect. F, perfect. Let's now keep doing this for the EV on Mbit. I know it is a bit boring, but we have to do that at TSF. Obviously, once that you have made this, all of this formula here, you just need to change. If you want to value another company, you just have to change the company here and its related financials here and here, and the model will run automatically. Okay. Now we have the next 12 months EBITDA divided by pi. This is a forward multiple or a leading multiple. These are all historical multiple. Just to, okay, perfect. Let's now go with the price to earning multiple. In this case, I need the net income divided by the market cap. Okay, perfect. Okay, so let's now calculate the minimum value of this range. Okay, let's now calculate the first percentile income. This is our array 1. Perfect. Let's now calculate the average, the median. Median, it is useful when you want to erase all the, when you have in a panel some really high, I mean, high range numbers and low and really low range numbers. So for instance, it basically just focus on the median value. In terms of the third percentile, okay, so with 0.75. Okay, and now with the maximum. Let's now grab all of the here. Left. Okay, perfect. Let's now do the same with the second panel, which is AMD. Okay, AMD. Perfect. Save. Let's now do the same for our Ebitda and P. Let's do also for the last multiple, which is price to earnings. Okay, not in this case, I need the markup. I need market cap. That's okay, perfect. Let's now do calculate the next 12 months multiple. Okay, okay. With the next 12 months EBITDA, the last 12 months the price value, and next 12 months EBITDA. Okay, the price value, perfect. TSF, Alt TSF, Alt ESF. Let's now copy and paste this summary matrix. Okay, perfect. Now we can calculate the coefficient of variation. It is a statistical metric used to analyze the dispersion of a bunch of data. So the lower it is, the better it is. If you want to, know more about this metric, I suggest just to type it on Google and look for it online. In my opinion, a good value would be from 0 to 50%. I think it is quite good. The formula is standard deviation, okay, divided by the average of, okay, so Control C. Okay, let's now proceed to exclude all the outliers. In this case, for instance, I have erased and excluded from the panel this value and this value too, because they are too lower compared to the others. And I did the same also here below. I excluded this. This is a very subjective process, so it's really up to you if you want a higher or lower valuation. Okay, so now let's go. There is a valuation date. Let's say today. Oops. Let's say today. Okay, perfect. So let's go now to the summary and let's calculate the value of Nvidia from the multiples that we have collected from our comparables. So in this case, I just want to make, as always, the model more dynamic. So I'm just going to add this form control. Okay, from control, input range, panel 1 and panel number 2. Okay. Okay, so in this case, okay, let's take for each one of these, let's take the average of the last 12-month data and the last fiscal year data. So in this case, we are talking about let's choose. We are talking about the first panel and the vote on revenue. Okay, so first panel, this one, a vote on revenue. I want the average. For the second panel, I want this. Okay, what's average? Okay, forgot. Okay, 4 point. Obviously, for a company, take wrongly the minimum, but for a company like Nvidia, obviously, I'd say that the enterprise value on sales, it is not the most fitting multiples. Generally, you should look an EV1 EBITDA, EV1 EBIT. I like more the EV1 EBITDA and the price to earnings ratio. Okay, let's now do the same with EV1 EBITDA. Let's take the average of the average last 12 months multiple and the average last fiscal year multiple. Okay, let's now do the same with our EBITDA and EBIT, sorry. Always the average of the last 12 month average enterprise value on EBITDA and the last fiscal year average enterprise value on EBIT. Okay, and let's now do the same with price to earnings. Average. You generally take an average just to normalize the data because the last 12 months maybe would be impacted by the latest market conditions. So generally taking an average, it is always a smart way to normalize the data. Okay, so now let's take the Nvidia financials. I have collected these financials from its annual report. You can find here all the financial data of Nvidia. Let's now do the same with the Ebitda. EBIT. Okay, let's now multiply. So this is the Nvidia enterprise value. Let me just to make the model more clear. Okay, this is the enterprise value calculated, the Nvidia enterprise value calculated throughout the comparable company methodology. Let's now add the net financial position because it is full cash. And we have no controlling interest or minorities according to the financial statement of Nvidia. Minus here. It's F. Let's now calculate. We're going to calculate directly the enterprise value when we use the price to earnings, because this is an equity metric, not a an unlevered metric. In terms of the shares standing, you can find them just going here online, Nvidia, current share standing, 2.468 thousands millions, sorry. So we have 2 4 but in my opinion, it is just because the current stock price of Nvidia is really overpriced. Price, if we look at the chart of the last year, you can see just like it soared, increased in the last year, in the last 6 months. So I have decided to collect the average of the last 1 year closing share price. So I'm just, if we look at the current, here we have 1.06, which is close, which is exactly the one I have put here. If we take this average, I've collected this data just here on Google, on Yahoo Finance. You select the time period, the historical prices, the frequency you want the data, and you then download them on Excel. If we compare F, if we compare this data with this normalized data with our implied share price, as we can see, we are a bit in line. If we look at these two multiples, and we are a bit overvalued if we look at this multiple. In my opinion, these two are quite reliable. So, in my opinion, maybe this could be a solid value, a reasonable value. If you look at the second panel, okay, so here, if we take an average of these two, probably we are a bit in line. We are a bit in line or slightly overpriced. 1%. In this case, we are more in line. By the way, obviously, you can value Nvidia using an average of, for instance, these two multiple. It's really up to you. Okay, so this is what the final model looks like. Always use not a financial recommendation. If you are interested in getting the video, please leave a like, subscribe to the channel, and leave a comment below in the comment section with your email, and I'm gonna send this model directly to you. So I hope you enjoyed the video, and see you in the next one.